Welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. So if you're a real estate investor looking at how you can invest in real estate with life insurance, you've come to the right place. I'm Tomrutkowski with Innovative Retirement Strategies, and today we're going to be talking about the magic checking account. And the magic checking account is a concept that I use to help explain how the double play works without the complexity of life insurance involved in it. A lot of times when I'm explaining the double play to people, especially in the forums, they get wrapped around the axle with the complexity of life insurance. Life insurance is complicated. Many people don't have a favorable opinion of it. And if you come into it without understanding what the cash value is and represents, and just a bias against life insurance, you're going to have a hard time with it. So the concept of the magic checking account is simply a way to show the cash flows and explain how the model works without the added complexity of trying to understand how life insurance relates to it. So if this sounds interesting to you, stick around after the intro and we'll get started. I'm Tom Rutkowski with Innovative Retirement Strategies, and I confess I'm a bit of a financial nerd, so things like compounding interest and interest rate arbitrage fascinate me. And I came up with the concept of the double play many years ago, and it's so powerful that I wanted to share it with everyone else. So again, if you're a real estate investor and you're looking to invest in real estate using the cash value of life insurance, no matter where you heard of it, you've come to the right place. So the goal of this channel is to give you the tools that you need to understand life insurance, understand how the double play works without ever talking to a life insurance agent. And along the way, we're going to debunk a lot of the life insurance myths and separate all the hype and BS from the facts and reality. So today's topic again is the magic checking account. And again, this is just a concept that I use. It's not a real thing. It's just a concept that I use to help explain how the double play works without the complexity of the life insurance in it. So the way I'm going to cover that today is I want to talk about it in light of how does a real checking account work. And then we'll compare and contrast that with what my hypothetical magic checking account looks like. Then we'll move into what the business model for the double play looks like when you utilize a magic checking account. We'll look at the double play with and without a magic checking account. So today's presentation, because I'm not going to be talking about life insurance as much, you don't need to have too great of a knowledge of any of the other videos that I've done, but certainly go down to the description and I've got links for Life Insurance 101, which will be very helpful to understand, as well as the business case for the double play and an introduction to the double play. All of those will be helpful as we go through this video. And while you're down there, be sure to give this video a like and subscribe so that you're notified whenever I come out with new videos. So with that, we'll get started as soon as I cover the disclaimers. All right, let's take care of some formalities first. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, so the goal of today's presentation is simply to explain the concept of the double play, coming at it from a little bit different angle, which I'm calling the magic checking account. And the magic checking account is not a real thing. It's just a hypothetical construct, but it makes it easier to understand how the double play works if you can think about it without the complexity and the bias that goes into utilizing life insurance. So let's start with a real checking account. When you have a real checking account, you put your money on deposit with a bank. They pay you little to no interest on your money. If you do get paid interest, that interest is taxable as income at the end of the year, ordinary income tax rates. And when you write a check off of that ordinary checking account, the bank simply transfers the money to the bank of whoever cashes the check. So the funds are no longer in your bank and you're not earning anything even if you had an interest-bearing checking account. So I think everybody understands how a normal checking account works. But basically what you're doing is you're giving the bank a loan of your money that you can call at any time, which is you going and writing a check or going and taking a withdrawal. But essentially, the bank has to pay back that loan as soon as you demand it, right? That's how a checking account or a savings account works. The bank, on the other hand, is taking that money that you're lending them and they're making loans with it. That's how banks make money. So they're profiting from an arbitrage on their side. They're paying you nothing for the use of your money, and they're utilizing it to make loans where they're charging other people money. So that's their profit. So let's compare this now with my hypothetical magic checking account. So in a magic checking account, the cash in the account is going to earn a nice attractive rate of return. Anywhere in today's world from 4s up to as high as maybe 7 or 8 when interest rates get back above the really low point that they're at right now. But let's just say 4 to 7% is what you can see or expect in today's market. So a very attractive interest rates on your money. The primary difference in a magic checking account is that when you write a check, you're not transferring the money out of your account. The bank is actually going to give you a line of credit secured by the assets in your account so that they don't have to transfer them. And what's going to happen there is, of course, if you're using a line of credit, you're going to owe interest on that line of credit. Well, if we just assume that your magic checking account is earning 5% and your line of credit is at 5%, then if let's just say if you had $100,000 on account and you wrote a check for $100,000 on January 1st, at the end of the year, you'd owe $5,000 on that $100,000. But if the magic checking account was growing at 5%, it would exactly offset that. So at the end of the year, if you paid back even if you never paid back the amount, each year the interest would simply accrue on the loan, but it's exactly offset by the growth on the cash value. So that could stay like that forever. But the net effect is it looks and feels just like a normal checking account because you've truly got a zero net balance. All of your assets in the account are offset by the liabilities of the loan that you've got. So you're at zero. So why would you do this? Well, for all practical purposes, given what I just told you, I mean, you wouldn't go out and buy something that you're never going to pay it back. But if you're going to invest with that money, that's a different story. So let's take a look at what things look like if you're investing with a magic checking account. So before we get into investing with a magic checking account, let's just talk about a little just business basics. You know, if you're investing your money into a deal, you want to make sure that you're earning a decent rate of return. Even if it's your own money, you might have a choice between an investment that earns 6%, one that makes 8%, and one that makes 10%. So which one would you choose? Well, most people would choose the 10% if the risk was the same across those different investments. If the 10% investment was riskier than an 8 and 8 was riskier than a 6, you would have to take risk into account. But people put their own money in, businesses put their own money into investments, expecting some rate of return that is enough to offset the risk that they're making on that investment. So there's a cost of capital, a cost of equity. There's also a cost of debt. So if a business, for example, is issuing bonds to finance a project or just raise capital for business, they have to offer that money at a decent rate of return for the investors who want to make that loan or buy those bonds from the business. So there's a cost of debt as well. So the point here that I'm trying to make, albeit in a roundabout way, is when you make a business decision to invest in something, whatever you're investing in has to earn a great enough rate of return to compensate for the risk of that investment and pay back the cost of capital. And risk may be factored into the cost of capital. But nobody, no rational person is going to make a business decision that doesn't result in a positive profit for the business. So if you're going to take 5% money, for example, and invest it, you want to make sure that you're earning at least 5%, right? There's to break even. But really, you want to make as much as you possibly can with that 5% money. If you can make 20% with that 5% money, that'd be 15% of profit, right? And then your net would be whatever you have left after you pay taxes. So let's take a look at a very simple example here. And this is utilizing the magic checking account. And there's no interest rate arbitrage in this. We're assuming here that the money that you're paying on your credit line, the interest that you're paying on your credit line, is exactly equal to the interest on the balance in your magic checking account. So let's just assume that you have $100,000 in your magic checking account, and you are making a private money loan to a real estate investor at a rate of 10%. Now, in your magic checking account, you're earning, we're going to assume just for the purpose of example, 6% on your balance. And you're also paying 6% on the credit line against that balance. So the interest that you're earning exactly offsets the interest that you're paying. Except in this case, we're actually using that money to make a hard money loan where we're making 10%. So if that's a 12-month hard money loan, the investor pays it back at the end of the year, so you've really got $110,000 at that point. So basically, you're finishing up the year with a gain of $10,000. Now, the cost of money to make that investment is a business deduction. So you would write off the $6,000 that you wrote a check to the bank for in order to make that investment. So your taxable income in this case is really $4,000 that's left after paying off your business expenses, which was the cost of money. Now, keep in mind, since the arbitrage is occurring outside the magic checking account, the balance inside your magic checking account is still earning that interest. So we have our money working in two places at one time here. So with our gain of $4,000, if we assume 40% taxes, we're going to write a check to the IRS for $1,600, leaving us with a profit of $2,400 on top of the $6,000 that are original $100,000 in the magic checking account, which is still there. Remember, we just borrowed or used a credit line to write that check to make that investment. So the money never left the checking account. So it earned $6,000. And to that, we added the $2,400 that we made outside the checking account. So our profit, when you combine the cash in the magic checking account with what's left over after we pay the taxes on our investment, is $8,400, or a net return of 8.4%. So that's the magic checking account. And now let's take a look at what it would look like if we made the same investment utilizing an ordinary checking account that most people use, right? All right, so in this example, we're using an ordinary checking account. So when you write that check for $100,000, the bank is literally transferring that $100,000 to the bank of whoever cashed the check. And then you've got a promissory note set up to pay yourself, to get paid back. So same situation, at the end of the year, the investor pays off the loan and you've got $110,000, $100,000 of which is the original principal and $10,000 of interest income on that loan. Now, since you didn't borrow any money, you have no expenses in this case. So the entire $10,000 gain is taxable at your 40% tax rate. So we write a check to the IRS for $4,000 and you're left with $6,000. So ordinary checking account, making the same exact investment, results in a net after-tax rate of return of 6%, $6,000 on that original $100,000 that we invested, versus the magic checking account where we turned that same $100,000 into $108,400. So you can see that there's a 2.4% increase in the performance of that magic checking account. And it's not just 2.4% better. When you compare it in percentage terms, 2.4% is a big percentage of 6. So you're making over a 3% higher return over time. So that's an example of the magic checking account in a situation where there's no interest rate arbitrage. And now I'm going to throw in a little bit of a complexity here, and you may not understand why this is, but let's just say that you can have your cash in the Magic checking account earning 6% while you're borrowing at 5%. So now I want you to imagine what your results would look like if you could introduce some interest rate arbitrage. What if you could earn 6% on the money in your Magic checking account and borrow against that money at 5%? So there's 1 percentage point of arbitrage. So this table looks very similar. You've got the same $100,000 in your Magic checking account growing at 6% per year. So at the end of the year, it's going to earn $6,000. Only this time we're writing a check to make that same hard money loan, only the interest that we're paying on it is 5%. So now at the end of the year, the investor pays off the loan, you get your $100,000 of principal back, you've got the same $10,000 gain, only this time we're writing a check for $5,000 to the bank for the use of that money for the year, and that's a business expense. So that reduces our $10,000 of gain down to $5,000 of taxable income. In the 40% tax bracket, we're writing a check to the IRS for $2,000, which leaves us with $3,000 left over after paying off the taxes and the interest. So if our original $100,000 that never left the checking account earned 6%, we have $6,000 there. And to that, we can add $3,000 that we created outside utilizing the arbitrage on the outside of the Magic checking account. So we created $3,000 there. So our net after-tax return is 9% on that original 10% investment that we made net of tax. And this is powerful. So that's how the Magic checking account works. And in this case here, it's a very simple construct. And I hope you can see how utilizing your money in two places at one time can benefit you. But again, we're playing in a theoretical world. And now I want to introduce the complexity of life insurance back into it, having come at it from a different angle. And hopefully I won't overwhelm you. So what does a Magic checking account have to do with life insurance? Well, the cash value of a life insurance policy is as close as we can come to creating what I've just described here with this construct of a Magic checking account. If you go back, if you don't understand life insurance, certainly go back and watch the Life Insurance 101 video and the introduction to the double play. But in a permanent life insurance policy, the life insurance company is essentially collecting premium from the policy owner. And a lot of that premium is going towards a savings account because the policy owner is essentially saving up their own death benefit over the course of their natural life expectancy. So as that savings or cash value accumulates over time, the amount at risk to the insurance company is the delta, the gap between the death benefit and the amount of savings that they've got. So in the beginning, when there's very little savings, the risk to the insurance company is very great. But over time, as the cash value accumulates, there's very little additional risk to the insurance company. So the risk is transferred from the insurance company over time to the policy owner. So that's what the cash value is, and that's why we get the tax advantage of it, because it's not being invested. It's part of the life insurance policy. And the beautiful thing is the state statutes of all 50 states require that insurance companies must make loans to their policy owners secured by the cash value of those policies. And banks don't want to be left out of that, so they will also give a loan to policy owners secured by the cash value of their policies. They simply need to give an assignment of collateral against the life insurance policy in exchange for the loan. So in a properly designed maximum overfunded life insurance policy, we should expect that every dollar of premium turns into about 85 cents of cash value. So about 15% of every dollar is lost due to the fees and expenses of the policy. So our goal when we're designing these policies is to keep the death benefit and the fees to an absolute minimum in order to maximize the cash value of the policy. The rates of return that I gave earlier for the Magic checking account are pretty much what most insurance companies are paying, whether they're a universal life or a whole life or an indexed universal life. The current yields that we're seeing in the market based on interest rates today range from 4 to maybe a little bit less than 4, but up to 5, 6, 7%. A few years ago, when interest rates were a little bit higher, we were seeing average annualized returns on index universal life that were closer to 8%. So it's not out of the realm of possibilities. It's just right now very unlikely. But remember, the insurance company is investing for the life of the insured. So they're investing in long-term assets with low liquidity, and they can afford to credit interest like that. That's the kind of money that they're making on the savings component of your policy. But at the same time, the policy loans that they make or banks make, let's look at the perspective of a bank loaning money to a policy owner. When you show a bank or can give a bank an assignment of collateral against a life insurance policy, they're giving you a loan that is 100% secured. And with that assignment, they don't have to worry about foreclosing. So it's a very low risk loan for a bank to make to a policy owner. And that's why they can afford to offer such low interest rates. And that's why we have the opportunity for arbitrage here. Why we can make 5, 6% on our money in the magic checking account, life insurance policy, and yet borrow against it at a lower rate. And even from the life insurance policy's perspective, the life insurance company, when they make a loan to a policy owner, that's a very low risk investment. So if you think of the insurance company spreading their money around in all sorts of different investments, they have high risk, high return, and they have low risk, low return. And a policy loan to a policy owner is a very low risk investment. That's why they can offer a lower policy loan interest rate than what they're paying on their general fund, paying as a dividend as a whole. I hope that makes sense to everyone. I often get that as a question. It's like, how can they afford to pay me 6 while they're only charging me 5 for a loan? And that's the reason. It's a different investment, different type of investment for them. All right, so let's take a look at the numbers for life insurance being utilized as a magic checking account. So here, $100,000, we're going to use the same numbers. It's just that when we're talking about life insurance, we can't simply take a lump sum of $100,000 and drop it into a life insurance policy like we're showing here. This would be the first of at least 5 premium payments of $100,000. So this is could be somebody who has $500,000 sitting in a savings account that they want to get into a life insurance policy. If the policy is designed right, that $100,000 of initial premium after the fees is going to result in about $85,000 being credited to the cash value of that account. And at the end of the year, that cash value is going to earn interest crediting or dividends of 6%. All right, so if we invested $85,000 at 10%, this is again, you're making a private money loan to an investor for $85,000 at 10%. At the end of the year, you've got interest income of $8,500. Now you borrowed the money from a bank, so you got to pay back the interest on that. That's $4,250. And then that leaves taxable income of $4,250. In the 40% tax bracket, that's a $1,700 check we're writing to the IRS, and that leaves us with $2,550 of profit. So if we look at our original interest that we earned on our magic checking account balance, we have $5,100. That's 6% on the $8,500 of cash value that we have. And then to that, we add our $2,550 that we made outside the policy, which gives us a total of $7,650. So compared to the situation where we use the ordinary checking account, remember our after-tax income there was $6,000. So our money is growing at a 6% after-tax rate of return, compounding yield. Here, in this example, we're getting $7,650. So we're achieving a 1.65% greater rate of return. Now, if you're short-sighted, you might think, well, I'm not even back to where I was originally. I still don't have my original $100,000 back. But if you're investing for the long run, and you have an opportunity to have your money grow at 1.65% higher rate of return year after year, even though you start off with less, your 100 turns into 85, that 85 is growing at a faster rate. So it will catch up to and surpass where the $100,000 would have been had it been growing at a net of 6%. And that's the beauty of utilizing life insurance for the double play. All right, so just wrapping up here, the whole purpose of the Magic Checking Account is just to explain the double play without the added complexity of explaining how life insurance works. It makes it a lot easier to understand the concept when you can simply look at it from a perspective of a checking account with a balance, which most people are familiar with. So coming at it from a different angle, I wanted you to understand how the cash flows work and the value of the double play. And then I introduced the concept of the life insurance in it. So again, if you don't understand life insurance and you want the more information on what the cash value is, when I talk about a maximum overfunded policy, go out and click on the link to watch the Life Insurance 101 video. Watch the introduction to the double play video. There's another one on the business case for the double play, which goes over all these numbers. And then finally, there's another video that covers policy design, which is very important to understand the difference between a maximum and a minimum overfunded policy. All right, so if you're still hungry for more information and you don't want to talk to a life insurance agent, I highly recommend going out to Facebook and looking for the Double Play group. It's a community of my clients and many other people who are utilizing life insurance for investing in real estate. And most of those people understand that by going to the Facebook group, people are going to ask questions. So go there, post your questions, talk to people who are actually utilizing this strategy, and you don't have to talk to a life insurance agent. I've got tons of resources and other videos on my YouTube channel and on my website. And I consider my website to be a no fluff zone. So you're not going to see lots of pretty pictures with fluff trying to get you to pick up the phone and call me. Everything that you want to know and learn, short of seeing an actual illustration, should be out there in blog posts and in other articles on my website. If there's anything that you want to see that you can't find, post a comment down below. In fact, if you have any questions at all whatsoever about how this works, even if you don't agree with me, post your points down below. I'm happy to engage in answering questions and friendly debate online to help the people who will follow and stumble across this information. So with that, I'm done for this week, and I'll see you in the next video. Thanks for watching.